PayPal total payment volume growth has been slowing. Top line has been shrinking at Conagra. I was asked about both of these stocks on Monday, and we're going to touch up both of them today on Open Interest. Hello everybody, I'm Mike Coe. Welcome to today's abbreviated open mic. I'm going to be joining the crew on Fast Money at 5 p.m. Eastern today, so I'm going to need to sign off a little earlier than usual. However, we're planning to do a live stream on Friday with my good friend and colleague, Professor Mark Guthner. So we'll be able to address some questions that you might give us today that we don't get to. We're also going to be discussing S&P valuations, and we're going to be talking about Bitcoin. So be sure to hit the notification bell if those topics interest you and join us here on Friday. Okay, so the dollar volume of digital payments, that's the total payment volume I was referring to before, is the main driver of PayPal's growth, and it reflects sales at e-commerce sites paid using the PayPal or Venmo checkout buttons plus peer-to-peer or other transactions made with those apps. A rising focus on small businesses and monetization of Venmo may push revenue growth to 6 to 7% or so between this year and 2026 based on the consensus estimates of the sell side that covers the stock. Now, transaction margins are also expected to stabilize. It should be mentioned that the company, some folks who have been, and maybe we can pull this screen up at the same time. So I just wanted to sort of show what the revenue picture looks like in terms of growth. We can see that the forecast over the course of the next 2 years is somewhat slower. So we had, relatively spectacular growth 2021. Let's just sort of set that to the side, pandemic, but we were getting top line growth. The couple of years that followed. The forecast from the street at this point is more in the 5 to 6.5% range over the course of the coming years, maybe as high as 7% in 2026. Now, normally a slowdown in sort of the key revenue measure, something like that would normally be some cause of concern for me. It should be mentioned that management has emphasized that they are really looking at monetization that flows to the bottom line. So, in other words, they're not simply trying to focus on, the headline TPV figure and are trying to make sure that they're going to have decent earnings growth as a function of this. I mean, they are in a core spot, but I wanted to just compare this rate of growth to other payment companies so we can get some perspective on how fast some of them are in fact growing. And the first one that comes to my mind is usually Visa in this area, because they have consistently generated really spectacular growth, in my view, for a mature business. As we can see, they've been getting something like 10% plus year-on-year top-line revenue growth with very fat margins, and that's not predicted to slow necessarily. That said, the big difference between these companies is really their valuation. So you pay a premium to get the the kind of growth rates that Visa has enjoyed. Now, you can see that multiple has come in a little bit since this sort of peak. And actually, we probably want to, again, ignore that, the pandemic period is kind of one of those things you might want to sort of throw away a little bit. So it's lower than it has been, but it's still higher than the market overall. Very reasonable price to growth, it should be said. So a payments company that I really do like. But you're going to pay considerably less at PayPal. So let's just take a quick peek at that. And this was trading well less on a forward basis, well less than 20 when I was looking at this earlier, and no reason to think that would have changed very much intraday today. So let's just blow this up a little bit, get a longer term view. So you can see it obviously has traded at a lower multiple, but 17.5 times with, call it a 5.5 to 6.5% top line growth rate is good. I would point out that this is one of those situations, though, that when you see slowing rates of growth, we always think about rates of change as being important. So how much a company is growing is important, but also if you start to see deceleration in that growth rate, you wonder whether that's part of a larger trend. So that's the one thing I would keep a little bit of an eye on. It's okay if we get down into that 5.5%, 6% growth. And of course, they've already reported earnings for this quarter, so it's going to have to, we're going to get a better sense of it in the next reported quarter after the new year. The other quick thing I would mention too, and this is not just true for this company, but for all of them, the incoming administration, with a bit of a mandate and having some, having control of the Congress, that party having control of the Congress, this is, poised for significant growth. We are not going to get, or it seems almost impossible to me, I would think, seems highly unlikely, I guess. Why don't we'll go with that. It's highly unlikely we're going to see corporate income tax increases at any point over the course of the next 3 years, right? So the first opportunity for such a thing would very considering that Trump has already stated that he wants to re-up the TCJA, the Tax Cuts and Jobs Act. It's very unlikely that we're going to see any corporate income tax increase until, the midterm elections following that. It would have to be. So that would be the absolute soonest time that such a thing would even be possible. And even then, we might view it as improbable, since it would have to get past the executive veto. So it would have to be kind of an overwhelming victory, unless there's some kind of a compromise made that suggests that corporate income tax increases are on the table. So what does that mean? I've previously said that the proposed corporate income tax increase that we had seen from the Democrat side was probably going to be, a net cost impact of, call it 6 to 7% net to S&P earnings. So that's off the table. I would also say that the incoming administration's policies, at least as we've seen them, are articulated, are more poised for growth. How much additional growth? Well, there are different estimates of this. No need to take my word for it. University of Pennsylvania did a study of the two plans, and the net impact, I believe, over the course of 10 years, estimated in the growth rates between the two things that had been articulated, was something in the neighborhood of 700 to 800 billion. I think that was a cumulative number. So the reason I point that out, actually, it was 700 to 800 billion net on the. So if we consider it's actually going to be a little bit bigger than that. Forgive me, because that was actually going to be the net tax, the net debt increase impact as a function of slower growth. So you actually have to divide that number by the effective tax rate. So that would probably be something in the neighborhood of. So let's see here, 800 over 10 years. We'll call it effective of 35%. So 2.3 trillion, 230 billion over 10 years. So 230 billion on a, call it $35 trillion economy. So we're really looking at about 60 basis points, give or take, of incremental growth to GDP, if we're thinking about it that way. And I think it would be reasonable to sort of just apply that unilaterally to your S&P valuations in terms of top line and earnings growth as well. So we're not necessarily going to, once we've factored in the tax considerations and then economic growth, and then just sort of take all of your growth estimates up by sort of like amounts. This is just a general sort of thumb in the wind kind of a thing. And justifies a slightly higher multiple, right? So, okay, so with that, so I'm generally positive on PayPal. I would just encourage folks to keep a close eye on that top line, on their total payment volume, on their next earnings call, and just sort of listen to the commentary and sort of see how things are going. So in terms of trades, because we would be bullish here. The other thing is we got some. It's not universally loved by the street, and that can be a good thing, right? I think. So we can actually take a look at that on the Bloomberg terminal so you guys can get a sense of just how many buys, holds, and sells there are. Not loved, and you can sort of see that in the valuation, right? So we've got 26 buys, 25 holds, 2 sells. The average price target is essentially where the stock is right now, just about $89. We did have one of these, I was taking a look at one of the research reports here. I think it might have been from Mizuho. Yeah, so they're one of the higher price targets on the name at 100. But even so, that creates a somewhat limited upside. So my thinking here is that that's kind of what you're going to play for. I don't really see anything coming along that's going to blow the doors off at this stage. So diagonals would be a way to play it. Call spread risk reversals, just because it's had such a nice run of late. You know, if you thought to yourself, okay, I'd be willing maybe to get long the stock where it came from, which would have been down around that $80 price level. So we could just do something that looks a little bit like this. We obviously don't need to trade something in the money. We can go up to the 87.5. So you're going to get, and again, you know, the mean price target is really not that much higher than the current stock price. This payoff that you're looking at here, so as a percentage of their own value, just bear in mind that out-of-the-money options will decay faster than the at-the-money options. There's actually a point when that sort of crosses over, because once options have essentially decayed, then, you know, there is no incremental decay. So when you see this, so you can imagine you hold this position all the way to an expiration. Ultimately, you're going to have a negative standstill rate of return. But that is not likely to be the case in the interim through December, while there's still some premium to the wings. Those are going to decay at a slightly faster rate as a percentage of their own value. So I'm not saying that the absolute theta, the absolute decay, is higher, but as a percentage of their own value. So that rate of decay is going to mean that your instantaneous decay for the whole package, for the whole call spread risk reversal, is actually not going to be that great. And so this is one way you could do it. Another way you could contemplate doing something like this would be, with some kind of diagonal. Although if you were going to do a diagonal and just try to write against it, then you might want to just keep an eye on, the next earnings, which is estimated to be the first week of February, as we can see here. So in that case, you might actually punch the long side out to the February regular way, maybe pick up the 87.5, so the 90s, something like that, and and then sell some nearer dated against it. So I'm just going to use December as an example. Normally I'm using the front month, but I'm not going to use that in this case because that's the day after tomorrow. So that's basically a little bit short dated. So trading's already done today, so I'm not going to tell you guys to go out and sell an option tomorrow that expires the following day. You can, of course, but if it's going to be, if you're more of a trader than an investor, that would be something you can consider. Okay, so on the Conagra front, and for those of you who don't know the company, these are their brands. I just happen to, I thought this would be sort of a helpful pictorial for those who are in it. Now, two things about this one. Here, the top line has actually been declining pretty precipitously. This company is cheap on a trailing earnings basis, but look at those brands and then say to yourself, okay, is that a growth business? Is that packaged food business a growth business? The answer to that is no. That is, we can see that in the company's operating results. Generally speaking, most of you who have tuned in before will know that I don't generally favor shorting stocks, so I just try to pick ones that we think we like in the long term. And generally, to make my list, I'd like to see companies that are growing the top line on or about as fast as the economy in general grows. So when I start seeing nominal rates of growth at the top that are less than 3% or so, that would normally not be on my radar of things that I would be interested in owning. This is not because I'm only interested in growth. I like value companies just fine. But companies that are shrinking relative to the economy aren't what I would normally classify as a value stock. I would classify those more frequently as a value trap. That said, there are some hints that they could stabilize. There was one other thing I thought might be interesting here, which is to take a look at the company's valuations. First on a price to earnings basis, and then, because if you look at it on this scale, you would say, okay, well, we're definitely getting in and around sort of trough valuations. And if you think their business could level off, buying the company at a very low double-digit multiple, probably 11, 12 times forward earnings, that seems quite reasonable. But I tend to toggle through a couple different valuations when I look at companies. And one of the ones that I wanted to look at in addition to this was price to sales. And the reason I wanted to look at price to sales is because if you look at this on a long-term basis, what you will see is that this is a company that generally had operating margins over this entire period. Okay, so we're talking about a period that goes 25 years from, call it, the 1990 through 2015. Their net income margins were in the single digits. Only recently have they managed to expand those into double digits. So when I think about the base case, I'm trying to think, okay, well, what if the top line remains flat or declines at single digits? What if we see a return to margins that were sort of more in keeping with their very long-term average? What would the earnings be then? Would it actually be 11 times forward, 12 times forwards? Well, actually, no, because a return to margins in that area are probably going to take, your multiple is going to actually be about 50% higher if you get back to those traditional multiples. And just for perspective, I'm just going to throw this in here so everybody can take a look at it. We can take a look at the, so we're looking at 10.7, 10.6, so just over 10% margins. Now let's just go way back in time here and see how far back I can go that you can take a look at and sort of see what I was looking at when I was taking a look at this thing from a historical perspective. And here you can see it, right? So as recently as 2008, 9, 10, we're looking at 5 to 8% margins. So actually, if you went back to like a trough margin back 2010, this thing isn't going to trade at, it's not really trading at 11 times. It's trading at 22 times that. So that I'm just trying to put some perspective on what the downside is. Okay. Final thing just to quickly address on this one is let's just take a quick peek at what the technicals look like. As we can see, most of the near-term technical indicators here are bearish. Not my work. I'm not the technical analyst, but not hugely positive. So those are the things I would say about that. One final point to make when you look at companies like this thing has a very fat dividend yield, right? So if that's your reason for owning it, that's totally fine. You could look to sell puts if that was kind of your thinking and you were looking for an options trade on it. The higher dividends are relative to interest rates, the greater the value of puts, all else equal. Because remember that the value of puts relative to calls is based on the cost of carry. The higher the interest rates are, the higher the cost of carry of owning stock. You can imagine, just think, I'm earning money in a cash account. I purchase stock instead. I'm foregoing that interest. So that's going to be baked into it, or else there would be an arbitrage. Similarly, if you're being paid dividends, you receive that if you own the stock. You don't if you don't. So very simply, that's going to adjust that calculus as well. You do not get dividends if you own calls, for example. So therefore, puts will essentially accommodate that, whereas the calls will not. So I think this is probably a candidate if you want this to be a core holding, probably of just selling puts, something like that. If you're looking for an options trade, otherwise just owning the stock is probably fine. Okay, and again, I don't have a whole lot of time today, so we're going to try to punch through things pretty quickly so that I can get on to the next bit. I saw a couple questions that I wanted to address. So the first one, eSmith23. This is with respect to GM. For those that didn't see the live stream, I pointed out that I liked GM as one of the less expensive ways to make a play on autonomous driving, because their Cruise subsidiary has very good technology in the space, competitive, I would suggest, with Waymo, and is trading at a very cheap valuation. Like a lot of stocks, this GM has done well. Not nearly as well as Tesla, by the way, because I was actually using Tesla as an example. 15 times the multiple. I was saying, look, you could buy GM and you get some of this great autonomous driving technology. Well, but you don't get Elon Musk suddenly becoming an important part of a new administration. So that was not part of my calculus when I was thinking about this, when I was suggesting General Motors on the long side, but I still like it. It's still cheap. All of the things I previously said about it are true. So yes, if you're long call spreads, up and out, that's probably the answer. Okay. And there's some other names in here that we're going to bring those up on Friday, but again, since I don't have a whole lot of time today, I apologize. So James Forbin asks, hi Mike, the SOX is down to the 200 exponential moving average line on the 1-year daily chart. Do you see a breakdown or a rebound off of the 200? So it's interesting that you mentioned that, because I actually did take... I did buy some puts on IGV today. And, it's not the semiconductor index specifically, but there's probably going to be some decent correlation to it. So, and Carter Worth actually pinged, he sent something out. Let me see what he had to say, if I can find it. Bear with me 1 second. For those of you who follow Carter Worth, somebody I like and respect, he was making a point. So for the expanded tech software sector in general, he said if you own it, book your profits if you happen to hold it. And he said for those engaged in short selling, we'd get in motion. That's a direct quote. So one quick point to remember, because this is something to think about. Let's just take a quick look at some other technical indicators. And I think this is it's important to think about the context of folks' recommendations, because different technical approaches have different horizons. Carter's horizon is typically looking out 60 to 90 days. We have other technical indicators that may be short-term bullish or bearish that have far, far shorter windows. So most of the technical indicators still remain bullish. I just want to put that out there. But he's got sort of a longer time horizon. So just bear that in mind as you think about it. But my thinking is, we've had a heck of a run here, and we haven't had anything sort of come out from the side that can shake people up a bit. I mean, today's there was the memes associated with the Department of Government Efficiency, this doji thing that has Vivek Ramaswamy and Elon Musk supposedly. I mean, it's remarkable meme fodder. And there's a lot of people who are taking that business from the movie Office Space, where the consultants come in and say, what exactly do you do here? Well, I had that in my mind when I was taking a look at today's inflation data, and I was thinking, what exactly do you do here? And the first thing I thought of was copy and paste, because all of the CPI data came in basically right on the survey number, which I thought was kind of funny. So I actually thought about replying to it, but I don't think anybody, I don't think Vivek or Elon Musk are paying any attention to any tweets or X posts that I do. But this is pretty much the perfect storm for a melt up through year end, if we can keep this kind of thing up. Strong economic data, inflation that seems vaguely under control, a business-friendly government, that all seems just about right. But there are plenty of stumbles that could come along, it should be said. And we've got NVIDIA earnings. And, the real question for NVIDIA isn't whether the demand is there. It's more of a supply question. So they're going to be reporting next week and, implying some pretty big moves. And it's a huge and chunky company. So as goes NVIDIA, so very well might many other stocks in the space, right? Okay. So Fluor, we talked about Fluor, and I was trying to remember when I saw this question when we talked about Fluor. again, for those that don't know, the thesis on Fluor was a lot of utilities had run up. There's a lot of conversations going on about bringing some nuclear reactors back online. Fluor is in that space where they both decommission and could potentially recommission mothballed nuclear reactors. They're in that engineering, procurement, planning space amongst those that could service that industry. So it was kind of a tangential play on that. And they also, by the way, as I may have pointed out, they also own one of those small modular reactor businesses that hasn't done any business. It's just a startup, so it's a money-losing thing. But they invested in the business. So that is, a name that I was interested in. And the stock did very well and essentially gave it all back just recently. And it sort of has come, it has basically come back onto or about where we were when we recommended it. So I still like it fundamentally, but we're getting into sort of a testy level. This is the level I would watch out for here, this 150, 46.5-ish, which is only marginally better than sort of that stop out level that I think I had provided when we talked about it a couple months ago. It was a little bit lower. That's sort of the thing I would be watching out for. Still like it, but if it violates that, probably might just pull the ripcord and look for another entry point. And gold. Close them on the move down. Now just buying into the ETF. Your thoughts? Yes. I still like gold. Look, gold and silver are the two original hard monies. We are in a growth and an inflationary environment. Higher rates in the United States, if we get that higher growth, are very likely. That supports dollar strength relative to other currencies, but still, I like the precious metals, even though they don't possess the attractive features that Bitcoin does. Most importantly, sort of transferability, fungibility, anonymity, all of those kinds of things. In other words, you're in a distressed part of the world. You can't flee wherever you are with a bunch of soon-to-be worthless currency, and you can't load your backpack full of gold. Get from A to B. Your Bitcoin is... I actually said to somebody just yesterday, I said, I think Bitcoin, if they had a motto, they could use Visa's old motto of, it's everywhere you want to be. That's one of its big functional advantages. And the other thing is that as the price of other proxies for wealth preservation and exchange, like gold and silver, you could always see some incremental increase in production. This isn't true for Bitcoin. Bitcoin is totally finite, but we're going to talk about that a little bit more on Friday. So FinWest says, I've liked Visa as well as MasterCard quite a lot. Have short puts position on both right now. Great companies, both. So yeah, big fan of both of those things. Schwab tutorial, they used a bull call spread with strikes in the money on Amazon, D's 205 210s, with Amazon at 223. Thoughts about this as a neutral strategy? Okay. Yeah, I'm not... If you trade a 205 210 in the money call spread on Amazon with the stock at 223, you're synthetically selling a credit put spread. That's the same thing. If you sold the 210 205, I don't know why they would do that. I don't know who did it. I'd give them a little bit of a talking to, not because it's not a total disaster. I mean, they're synthetic equivalents of each other, but why? It doesn't make complete sense to me why you would do that rather than sell a put credit spread, because those are basically the same thing. I'm going to illustrate that in the very limited amount of time that I have left before I have to hop off and join CNBC. You guys can tune in to Fast Money if you want to watch that, but there's going to be a lot of voices other than my own on that show. So let me just pull this up really quickly. I'm going to put these two things side by side so we can just see functionally synthetic equivalents of one another. So we're just going to put it in December. Why would they do that? Oh, yeah, I may have, yeah, someone just asked me, did I have a light theme before? So there you go. So here is the long call spread, okay? And now we're just going to go and create a put spread, and it's just going to be basically the same thing. So I'm just going to sell the 210s put and make that the 205 put. And look at that. Synthetic equivalents of one another. You know, why you trade them both in the money? Why? Oh, here's a good question. So why would I actually discourage it? And that is because if I'm trying to leg a trade, what has a tighter bid-ask spread to begin with? And what has less delta if I'm trying to leg it, go piece by piece? An out-of-the-money option is typically, you know, by the same amount of money, is typically going to have a narrower bid-ask spread and less delta. So it makes executing the trades simpler as well. Does it really matter? I'm not, you know, I probably should talk to whatever strategist it was that recommended that before criticizing it too much. But I would probably favor using a put spread. My 2 cents. I wish I could stay with you guys longer, but tune in on Friday where we're going to be talking about S&P valuations, more of these questions. Put them into the chat if you have them, and we're going to talk about Bitcoin. And I thank you all for tuning in and watching. And I will see you next time. Thanks for watching.